Investing in the stock market is about to seem a whole lot easier. Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. In the next few minutes, I'm going to help you understand how to get started with investing in the stock market. It might turn out to be easier than you think. To make things simple, I'm going to break this video down into 3 sections. First, we'll talk about what investing is and why we do it. Second, we'll talk about several different types of investing accounts and how they function. And third, I'll give you a simple, high-level overview of how to go about investing the money you've saved in those accounts from a beginner's perspective. Make sure you stick around until the end because that's when I'll share my 3 keys for being a successful investor. Stay tuned. On a basic level, investing is using some of your hard-earned money to purchase assets like stocks, bonds, or real estate that you believe will increase in value over time. Investing generally has a long time horizon, meaning that you presumably will hold on to the assets you buy for a period of years or even decades. This is fundamentally different from the practice of buying stocks and selling them weeks, days, or even hours later, hoping to earn a quick buck. That's what I refer to as trading, and if you clicked on this video hoping to learn about the latest hot stock picks, then I'm sorry, but that's not what I'll be discussing. So why do we do this thing called investing? Simple. Think about what you want your life to be like 30 or 40 years from now. Do you think you'll still want to go to work every day to earn a paycheck? Will you still be physically able to go to work every day? That's when your investments will come into play. Hopefully by the time you're ready to quit working, the assets you've invested have increased in value enough to support you financially for as long as you live. If not, you'll need to continue working against your wishes, ask friends and family for financial help, or rely on government programs like Social Security, which, as I'm sure you've heard, may or may not be around by the time you're old enough to take advantage of it. As the saying goes, the best time to begin investing is yesterday. That's because the longer you hold on to your assets, the more time you give them to grow in value. If you're 25 years old and just getting started, you have a big advantage over someone who's 45 years old and in the same position. Assuming that you both plan to stop working at 65 years old, any investments you make now have twice as many years to grow. That's a huge deal because of compound interest. Such a huge deal, in fact, that I made an entire video dedicated to that one concept. Link below. Now, that said, there is a situation in which I believe you should pump the brakes a little bit on investing, and that is if you have consumer debt. If you have credit cards that you're not paying in full every month, monthly car payments including leases, or student loan debt, you should pause most of your investing and instead focus on becoming debt-free. Once you're debt-free, you can really go at this thing full force, which is what it will take to be successful. Next, I'm going to tell you about 3 of the most common types of investment accounts. But before I do that, if you feel like this type of content is valuable, let me know by giving this video a thumbs up. And don't forget to stick around until the very end for my 3 keys to becoming a successful investor. Thanks. Alright, so the 3 primary types of investment accounts you need to know about to get started with investing are the 401k, the traditional IRA, and the Roth IRA. Are there other types of investment accounts? Sure. But these are the 3 I believe you need to understand to get started. Each of these accounts are similar to a basic savings account at a bank or a credit union, but with some special abilities and tax advantages. What do I mean by special abilities? Well, for starters, the money you deposit into these accounts can be used to purchase investments like stocks and bonds. With a regular savings account, you get a little bit of interest each month, and then that's about it. And then there's the tax advantages, which I'll talk about next when I go into a little more detail about each account type. First, I'll touch on the 401k. This is an investment account that might be available to you through your employer. Depending on where you work, it might be called something different, like a 403b or a 457b. All very similar. Your supervisor or human resources rep will help you get this set up. You decide what percentage of your income you want to invest. Then that amount is automatically subtracted from each paycheck and deposited into your 401k account. The 401k is an awesome type of investment account because it's automatic. You can set it and forget it, and you'll never be tempted to spend that money elsewhere because it never hits your bank account. As an added bonus, your employer might match the money you deposit in your 401k dollar for dollar, which doubles the amount of money you can invest with. That's a huge deal, and it's pretty much the only reason I'd consider investing before I was debt-free. If you change jobs, you can transfer the money in your 401k account to a new 401k account at your new employer, or to a traditional IRA, which I'll tell you about next. If you want to learn more details about what a 401k plan is and how it works, I made a video dedicated entirely to this essential investing account. Link is below. The traditional individual retirement account, or traditional IRA for short, is the second type of investment account you need to know about. It's very much like the 401k, except it's not set up through your employer, and the money you elect to deposit is not automatically pulled from your paycheck. You can open a traditional IRA on your own with a brokerage like Vanguard, Schwab, or Fidelity. You can then transfer money into the account whenever you like, or set up an automatic monthly deposit directly from your regular bank account to the traditional IRA. The money you deposit into a traditional IRA or into a 401k is pre-tax. That means it does not count as income when you're filing your tax return. It's the government's way of encouraging you to save money for later on in life. The Roth Individual Retirement Account, or Roth IRA for short, is just like a traditional IRA, but with different rules when it comes to taxes. The money you deposit into a Roth IRA is after taxes, meaning it does count as income that you need to pay taxes on before you go and start investing. That might seem like a bad deal at first, but later on, when you withdraw money from your 401k or traditional IRA, it's taxed just like ordinary income. On the other hand, any withdrawals you make from a Roth IRA are 100% tax-free. Now that's something. Want to learn more about how a Roth IRA compares to a traditional IRA? You're in luck. I've made a video on that exact topic as well. Link is below with the others. Last but not least, let's talk about how you should invest the money you've worked so hard for and deposited into your investment account. When you sign into your account online, you'll see some options for what types of stocks or bonds you can invest in. With a 401k, you'll probably have a limited set of choices. With an IRA, traditional or Roth, there will be more options than you'll ever be able to understand or comprehend. But none of that matters, because what you want to look for is something called a target date fund or a target retirement fund. A target date fund is a collection of stocks and bonds that have been selected for you based on the number of years remaining until you plan to retire. That collection will then be automatically adjusted for you over time to suit you best as you get closer and closer to retirement. All you need to do is figure out what year you'll turn 60 years old or what year you'll stop working, whichever is later. Then find the target date fund with the year closest to the one you came up with, and direct all of your money to be invested in that fund. It's that easy. Now, if this stuff really interests you and you want to dive a little deeper into the world of investing, search for index funds. These are large collections of stocks from all sorts of companies, representing different slices of the overall market. Direct a percentage of your investing dollars to one or several of those. Pay attention to the expense ratio. This is the fee you're charged every year to cover the cost of managing the index fund. If you have $10,000 invested in an index fund and that fund has an expense ratio of 0.4%, you pay $40 per year. The lower the expense ratio, the more money that stays in your pocket. Pay attention to the risk level. Conservative funds might not ever lose much money, but they probably won't gain much either. High-risk funds have the potential for big gains, but also for big losses. Pay attention to how the index fund compares to the benchmark. A sign of a well-managed index fund is a high correlation between the total return and the benchmark. One thing I would advise against is investing in a single company by purchasing that company's stock. By doing so, you're betting on the success of that one company, rather than the success of a large collection of companies or even the market as a whole. Is there a possibility you get in early with the next Amazon or Tesla? Sure, but that's like finding a needle in a haystack. I prefer to just buy the whole haystack by investing my money in broad index funds. Now, if you can't resist the urge to buy individual stocks, make it a small percentage of your overall portfolio. Take 4 or 5% of your money and just go have some fun. Just don't be surprised if you lose it all. Being a successful investor isn't difficult, but in general, it isn't very exciting either. It's all about starting as soon as possible so that your investments have more time to grow. It's about being consistent and disciplined, contributing a predetermined amount of money to your investment accounts every paycheck, every month, and every year. And most importantly, it's about staying the course, understanding that the amount of time you spend in the market is more important than the impossible task of trying to time the market. And that, my friends, is how to start investing in the stock market. What sort of 401k match does your employer offer? I'd love to hear about all the different and unique benefits out there. Let me know in the comments. If you enjoyed this video and would like to learn more about how a 401k plan works, click right here. And if you're not yet a PPF subscriber, click right here. As always, thanks for watching. I'm Andrew Scheer, and I'll see you next time.